Effectiveness of artificial intelligence is increasing at a rapid rate. So investors are looking at this category and trying to capitalize by buying stocks that will benefit from the growing effectiveness of AI. So in this video, I'll compare two companies that are trying to capitalize on that trend, Tesla and ARM Holdings. Of course, Tesla is trying to build driverless cars, which it has been forecasting for over a decade now that it'll have driverless cars on the roads sometime soon. ARM Holdings, meanwhile, sells the proprietary technology for the electronic components that goes inside electronics that facilitate artificial intelligence in devices like smartphones, computers, and data centers optimized for AI. So I'll compare these two and answer which one I think is the better buy today.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Let's start by comparing Tesla and ARM Holdings on revenue growth. So we have a lot more data on Tesla since they've been a publicly traded company for a longer time than ARM Holdings. But the trends are clear when we compare these two. Tesla's revenue growth rate has been decelerating since 2017. The company's prospects are diminishing, while it's trying to pivot and turn itself into an AI company. Understandably, because the sales of electric vehicles are not going as well as expected. The company said that this year they expect to grow revenue between 20 and 30%. I'm sorry, I should say they said they will grow the number of units sold by 20 to 30%, but the year is off to a slow start as the company reported, or there was reports that came out that Tesla's sales year over year in January have declined in several major countries, including China, France, Germany, and the United Kingdom. And then data from the state of California came out that showed Tesla's losing market share in that area as well. Meanwhile, ARM Holdings management told investors that they expect to grow their revenue between 20 and 25% for the next several years, as these devices that are coming out require more components because they need more computing power as a result of the rising effectiveness of AI. There's more AI going into smartphones, laptops, iPads, tablets, etc., and that requires more components, more computing power. All of that benefits ARM Holdings as it holds proprietary patents on the technology that goes inside those devices. So its prospects look stronger than Tesla's prospects over these next 2 to 3 years. Comparing these two on operating profit margins, ARM Holdings is also doing better in this regard compared to Tesla. ARM Holdings operating margins were declining until the start of 2024. Then it rebounded up to 12%. Those margins are expected to continue rising. As I mentioned earlier, for the same reason, the devices are requiring more components, and ARM Holdings is generating a higher price per component in those devices as well. Meanwhile, Tesla's margins are declining down to 7.94%, and according to management's forecast for 2025 and 2026, it looks like their margins will continue falling because they're going to focus on unit growth. So even if they have to lower prices and offer more incentives to sell electric vehicles, they're going to do that so that they can continue growing the number of units sold, even if they have to sacrifice profit margins. That's just what they have to do because competition is taking market share, and Tesla cannot sell those cars unless they lower the prices and offer significant promotions. Now, 5 years from now, if the company does have driverless cars on the road by that time, that should work to lift its margins. But that's a long time from now, and competition could come in and have driverless cars on the road in major cities before Tesla gets itself going. It is testing in June of this year. It's going to start testing its driverless cars on roads in Texas. It's going to start off really slowly, so don't expect anything quick from Tesla. But also, they could develop the lower priced model. And if they can generate sales from that lower priced model, That could also lift Tesla's margins as well, but it doesn't look good for Tesla's profit margins anytime in 2025, probably not even in 2026. Cash flow from operations to sales tells us a similar story. ARM Holdings better than Tesla in this regard, 21.82% in their cash flow from operations to sales, and Tesla at 15.28%. They're both trending lower, however, in this metric going back several years. And Tesla's cash flow from operations to sales are likely to remain flat or decline for the similar reasons I highlighted, that their operating margins are expected to decline. The return on invested capital measures how good a company is at taking investors' money, investing it into products that generate profits. In this regard, again, ARM Holdings better than Tesla, and ARM Holdings is moving in the right direction while Tesla is moving in the wrong direction. Tesla's return on invested capital of 9.57% is worse than ARM Holdings. It's also lower, way lower than the company's weighted average cost of capital. So it cost Tesla more to get the capital from investors than Tesla is earning on that capital. And a business is not adding shareholder value when it's in that situation, when the weighted average cost of capital is higher than the return on invested capital. Now, it's okay sometimes to invest in a business that has that going on, so long as you expect that trend to improve over the future. I don't think that's going to improve for Tesla, not in the next 2 years, maybe starting 3 years from now, 5 years from now, 10 years from now, that trend could improve. But it's a very capital intensive business. If you think about building cars and selling cars, it's so capital intensive. And sure, Tesla may have driverless cars on the road 5 years from now, but they still need to build those cars. And that's a capital intensive business model, which will require continued reinvestment into the business. And it remains a big question mark if the profits will justify all of the investments that's going in. Tesla said that they've already invested $5 billion on their driverless car technology, and they'll likely have to spend at least another $5 billion more before they have a single driverless car operating on the roads. ARM Holdings, meanwhile, is the opposite of Tesla. It's a very asset-light business model. ARM Holdings invests in research and development, and then it generates revenue by selling the licensing and taking royalties from its technology that it allows other companies to use. And so it's the opposite. And that's why you see its return on invested capital is already so much better than Tesla. I expect ARM Holdings will always have a better return on invested capital than Tesla, just because their business models are so different. All right, so given what we've seen so far, you would think that ARM would be selling at a more expensive price than Tesla. But because Tesla stock has so much momentum and enthusiasm and hope built into it, it's trading more expensively than ARM, even though every single metric we looked at, ARM was considerably better than Tesla. This is one of those situations where it's an easy decision. If I had to pick one of these two stocks, ARM is better in almost every regard compared to Tesla, and it's selling at a lower price. No, not too much lower, a forward price to earnings of 77 compared to 85, but still it's lower, and it was better than Tesla in every one of the critical metrics I evaluate when looking at a business. So if I had to pick between these two, by the way, I wouldn't want to own either of these at current valuations. I think they're both overvalued. But if I had to pick one, I would pick ARM at current prices. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.